Hello, hello,
Hello.
hello. Yeah. Hello. Yeah. Hello. Yeah. Welcome students. So let's begin with the today's session, and we are here together for the just a second. Yeah. So this is CACS Pushkaraj Vishnu Joshi, and we are together for the ICWA final paper 20A, that is strategic performance management and business valuations, in short called as Spm&Bv. And we are together for almost 30-40 sessions as such, and today's session will be, and so far I have covered 8 modules, and today we'll be starting with the 9th module. In 9th module, which is about valuation in mergers and acquisitions. So this is a specific corporate event which happens or in a business organization, and in such scenario when mergers and acquisitions are happening or various other kinds of corporate restructuring per se are happening, then how the valuation should be done and what are its impact, what are the tax benefits, etc. we will be seeing in this module. So this module has 3 chapters. One is the acquisition pricing, so how the pricing should be done of when a business is being acquired. Secondly, acquisition outcome, and third is the financial modeling. So in this session I will be taking up financial modeling, and as a matter of practice I have restricted myself as had been advised with the institute study material itself, and the study material is classically prepared, and in the session I will be walking you through the entire study material chapter as such, and my PPT during the session will cover the theoretical part of the chapter in a summarized, crisp and concise way, whereby it can act as a handy study notes or revision notes for yourself while preparing the exams. However, having said so, if at all you want to go for a deep dive concept clarity along with the problem solutions, illustrations, examples, you must refer to the study material of the Institute of ICWA. So let's begin the session. So it's about financial modeling. Again, this chapter is very small. If you see the study material, the chapter is at the most of theoretically at the most of 3 pages, and thereafter there are a lot of, because it's all about financial modeling, there are a lot of problems and solutions that have been solved over there. So I'm covering the theory part. So financial modeling, what is meant by financial modeling? Let's understand that. So financial modeling involves building spreadsheet models to project a company's future financial outcomes quantitatively. So that's what in a way it's about financial analysis, financial forecasting, and thereby modeling means typically preparing a template, and that template in a way helps for the future benefits and future usage also, and this template typically is all about forecasting in a Excel spreadsheet. So typically financial modeling involves building means setting up a template or drawing a template in Excel, or preparing a template in Excel, or formatting Excel, which is typically called as a spreadsheet model, to be able to project a company's future financial outcomes quantitatively. So if in short, the financial modeling is using spreadsheets or Microsoft Excel or any other similar kind of a tool to prepare financial forecast for a company. So the spreadsheet like MS Excel serve as a tool for creating these models. The spreadsheet is the medium, while the financial model is the final output or final product. So typically in earlier days when computers were not there, typically the financial forecasting used to be done by the various organizations, but it was done manually. Now since with the advent of technology and computers, and more so various spreadsheets that are available as a tool, it's in a way possible to set the template or formatting for preparing financial forecast for a particular organization. Therefore, spreadsheet is a medium or a tool, and financial model is the final product which is required to be, or which is prepared under, and that's what is called as financial modeling. So in short, it's financial statement analysis usually done with the forward-looking decision-making purpose. Prospective analysis includes forecasting and valuation, which helps express forward-looking insights. So if at all, for example, a company wants to do budgeting for the next year or next 3 years, or say next 5 years, then how do we do it? Then it will use or take help of the Microsoft Excel like spreadsheets, and in that it will start preparing the template, setting the reports that are expected for preparation of financial statement, and the financial forecasting also, and therefore and thereby it will be able to use a spreadsheet to forecast the future and future financial statements or future financial figures. So in short, financial statement analysis is usually done with the forward-looking decision-making purpose. That's the whole use of financial statement analysis. And prospective analysis includes, so after once the financial statement analysis is done of the past recent period, so say 2 years, 3 years financial statement analysis is done, a trend is identified, a trend is established, and thereupon the prospective analysis is done thereafter, which includes forecasting and valuation, which help in a way to express the forward-looking insights for that particular business or organizations. So effective forecasting should be comprehensive, covering profit and loss, cash flows, and the balance sheet. So traditionally the financial statements are three types of three statements are considered as financial key financial statements and those are the balance sheet as on a particular year end date or as on the end of the accounting period. Secondly, it is the income statement or profit and loss account or profit and loss statement for a particular period, accounting period. And third is the cash flow as on end of the accounting period. So therefore the effective forecasting should be comprehensive, covering all these three financial statements, and thus a holistic forecast helps avoid unrealistic assumptions even when focusing on one aspect of performance. So that's what is financial modeling in a way, as an introductory concept. Now let's look into how good a financial model can be and what are the attributes of a good financial model. And typically the characteristics or features of good financial model includes that it first and foremost it should be realistic, because it's all about future forecasting, therefore it should be realistic. Secondly, it should be in realistic, typically the outputs must reflect practical real world expectations to support decision making, even if it takes more time to build. The second attribute or characteristics or feature of good financial model is that it should be error free. So models must be thoroughly tested and reviewed to eliminate both obvious and subtle errors. So there should not be any mistakes. That's what the good financial model attribute is. Third attribute is that it should be flexible. The model should handle a variety of questions or scenarios, increasing its usefulness. So in a way it should be so flexible that it should be able to calculate and forecast all types of what if scenarios and all types of permutations and combinations also of financial forecasting. Fourthly, it should be easy to use. It should be usability should be prioritized over the aesthetics. Intuitive models are more effective. So in a way it should be user friendly, easy to use, easy to understand, easy to prepare also, and should not be complex at all. Another good attribute of a good financial model will be understandable formula. So use of concise descriptive cell and range names, avoid overly long or complex formula, and consider visual basic for clarity. So VBA for clarity. So that's what understandable formula, if at all used, then in a way it is a key attribute of a good financial model. Minimal hard coding. So minimal hard coding involves avoiding embedding fixed values in formula separate input and formula cells clearly. So in a way, minimal hard coding should be involved in the financial model. That's what the key attribute of a good financial model is. And lastly, it should be well documented. There should be proper handy user manual or notes or guiding or guidelines which will help to understand how the financial model has been prepared, and also at the same time will able to in a way be auditable also. So well documented includes clear documentation of assumptions, inputs, outputs, and a description of the model briefly, so that it can be well understood by anyone who is looking at the model and doesn't involve any technical stuff, so as to be really well versed about the financial modeling as such. So these are the attributes of good financial models: realistic, error-free, flexible, easy to use, understandable formula, minimal hard coding, and well documented. So let's understand financial statement forecasting, because finally financial modeling is nothing but financial forecasting only, but with the help of a spreadsheet or MS Excel like softwares or tools. So objective of financial statement forecasting is to create pro forma financial statements to make informed financial projections and decisions, commonly used for business valuation. Coverage wise, it involves modeling all three primary financial statements, namely income statement, balance sheet, and cash flow statements derived from the first two. So cash flow statement is a derived statement from income and balance sheet only, and therefore, however, though it's a derived statement, it is considered as one of the primary statement only, and therefore three primary financial statements are covered in financial statement forecasting, namely income statement, balance sheet, and cash flow statement derived from first two. The key steps that are involved in financial forecasting are, first and foremost, define the expected use and required output of the model. So one has to start with an end in mind, and therefore the purpose why this why a particular financial modeling is being prepared should be very clear to the modeler or model creator. And secondly, the final output of the model should be very clear. What exactly is required as a end product of that financial model or the outcome. Thereafter, collect historical data, which includes company data, industry data, competitors data. Understand company plans and create modeling assumptions. Build and debug the model. Refine the model based on feedback. So that's how the key steps are involved. So build and debug the model. Build and debug the model means prepare the model, prepare the pro forma, test it, try it with all permutations and combinations, all types of scenario. And if at all there are any errors in calculations, in formula setting or coding as such, then try to debug them and thereby refine the model based on the feedback that is being given by the users acceptance testing that will be done. So this is about financial statement forecasting. Continuing with financial statement forecasting, another aspect or this thing is historical data. So use 3 to 5 years of financial statements for trend-based forecasting, because it's all about forecasting. It can't be just in air. There has to be some premise, some basis, and for these bases to be able to analyze the past and thereafter forecast the future. So that's how historical data should be used of at least 3 to 5 years, substantial period that will be authentically available of financial statements for trend-based forecasting. Ensure consistency, not necessarily perfect accuracy. Include industry and competitor data also. include industry and competitor data for benchmarking, because merely doing a forecasting of your standalone company or organization might be misleading at times. There has to be some kind of a industry and competitors data also to be factored into as a benchmark to create a benchmark while creating financial forecasting. Consider industry forecast, example GDP, economic forecast also, example GDP, interest rate, price trends, etc. Company plans, now these are very much essential. So while preparing the financial modeling or financial statement forecasting, the company plans should be well known to the creator of the model. So crucial for realistic forecast. Incorporate strategic plans, example new projects, expansions, and reflect impacts on sales, cost, capital expenditure, working capital and profits. Then comes in financial statement forecasting is the common size statement. Now these common size statements are express income statement items as percentage of total revenue and balance sheet items as percentage of total assets. So in this common size statement, typically you being or the listeners of this session would be typically of finance background or management accountants per se. So they know what exactly a common size statement is, but however in a snapshot I'll try to. So let's say income statement is there, then for income statement the base will be taken as the sales figure, and then each and every item of the income statement will be related to the relationship will be found numerically with the sales figure. So numerator will be the respective separate line item of income and statement, and denominator divided by the denominator, which will be the sales figure into 100, and that's how every line item will be expressed as in terms of a, so express income statement items as percentage of total revenue. Then in case of balance sheet, the items will be expressed as a percentage of total assets. It helps in identifying significant changes or anomalies between the in separate line items of or the components of balance sheet and income statement also. Thus it enables in comparison between firms or different sizes. So common size statements in a way help to have comparability with the various other firms of different sizes also while doing the financial forecasting. So this is how financial forecasting is done, and these are the various concepts in financial forecasting. So identifying independent and dependent variables in financial forecasting. So the forecasting approach, no single correct method. It depends on business understanding and forecast quality. Sales driven forecasting is most commonly used. So these are the attributes of forecasting approach. So there are various types of forecasting approaches and methods within forecasting approaches. However, no single correct method, depends on business understanding. So there is no specific fixed method as such, a single method or a correct method. The method that is adopted in forecasting approach will always depend on the business understanding and the forecast quality. Sales driven forecasting is most commonly used. So majorly the independent variable is always the sales as independent variable. So sales growth rate often used as the key driver. The common size statements help identify which P&L items can be projected as a percentage of sales. Historical trends and stable relationships in common size statements guide initial forecasting. So use of industry data, combined company specific data with industry benchmarks for improved accuracy. Confirm assumptions using both historical and industry data. So use of industry data should be made always in the financial forecasting. So in continuation with identifying independent and dependent variables, the policy assumptions play a very critical role while doing the financial forecasting. So policy assumptions have to be clearly mentioned and agreeable to the management and should be well documented also. So it includes management's target, example debt to equity ratio, dividend growth in forecasting, and document all such assumptions very clearly, because the entire premise of financial modeling will always depend on the assumptions and policies that have been adopted and accepted and agreed and followed during financial modeling. So documentation of all such assumptions, policies, interpretations, and what you can say, information and data should be well documented. Then comes the non-sales driven items. So non-sales driven items mostly are the finance costs. So interest expense depends on loan amounts. Depreciation is tied to fixed assets, methods, rates, and asset age. And taxes are based on profit before tax and statutory tax rates. So these three items typically are nothing to do with sales as such, and are absolutely non-sales driven item, and hence they have to be forecasted accordingly. They cannot be linked to sales. They have their own base, as base is different than sales. Balancing the balance sheet. So even accurate forecast may lead to imbalances. Use a plug to balance. So while forecasting also balance sheet, the balance sheet has to tally. So balancing the balance sheet is very critical. Even accurate forecast may lead to imbalances, and in that case, organization has to use a plug to balance. Common plug items are the cash, marketable securities, or short-term, long-term debt and equity. So balancing should be done either in equity or the long-term long-term loans. Choice of plug depends on the financial scenario. Example, normal versus funding need. Ensure only one plug is used to maintain model clarity and integrity. So these are the in a way do's and don'ts to be considered while identifying independent and dependent variables for preparation of the financial modeling. So with this, in a way, we come to an end of the chapter. As I said, it's a very small chapter, hardly 3-4 pages in the syllabus or in the study material of the institute. As a matter of practice, I will, before ending the session, I will recap what we have understood. So in this session, which is about section B of paper 20A, module 9, valuation in mergers and acquisition, we saw financial modeling, and over there we understood and got introduced to what exactly financial modeling means. So financial modeling involves building spreadsheet models to project a company's future financial outcomes quantitatively. Spreadsheets like MS Excel serve as the tool for creating these models. The spreadsheet is the medium or a tool, while the financial model is the final product. Financial statement analysis is usually done with a forward-looking decision-making purpose. Prospective analysis thereafter includes forecasting and valuation, which helps express forward-looking insights and which are purely based on the financial statement analysis. Effective forecasting should be comprehensive, covering profit and loss account, cash flows, and the balance sheet also. So thus a holistic forecast helps avoid unrealistic assumptions even when focusing on one aspect of performance. Attributes of good financial models we saw. So they should be realistic, which means outputs must reflect practical real world expectations to support decision making, even if it takes more time to build. Secondly, the second good attribute is it should be error free. So models must be thoroughly tested and reviewed to eliminate both obvious and subtle errors. Flexible, the model should handle a variety of questions or scenarios, increasing its usefulness. Easy to use, usability should be prioritized over aesthetics. Intuitive models are more effective. Understandable formulas, use concise descriptive cell and range names. Avoid overly long or complex formulas. Consider VBA for clarity. Another critical attribute of good financial model is that there should be minimal hard coding. So avoid embedding fixed values in formulas. There should be separate input and formula cells clearly. So there has to be, in the modeling, there has to be separate input and formula cells clearly should be identified. The last attribute for a good financial model is having created the template, it should be well documented, which means it includes clear documentation of assumptions, inputs, outputs, and a description of the model. Then we saw what is meant by financial statement forecasting. So objectives of financial statement forecasting is to create pro forma financial statements to make informed financial projections and decisions commonly used for business valuations. It involves modeling all three types of three primary financial statements, namely income statement, balance sheet, and cash flow statement. And this cash flow statement typically is derived from the first two, that is income and balance sheet. Then the key steps involved are defining expected use and required output of the model. So financial forecasting model should begin with an end in mind. It should collect historical data, namely company data, industry data, and competitors data also. Understand company plans and create modeling assumptions accordingly. Thereafter, build the model in spreadsheet. Run past the data through it, see whether there are any errors. If at all there are any errors or presentation needs, then accordingly the refinement of the model has to be done. At the same time, if there are errors, then the debugging of the errors should be also done. Thus, finally refine the model based on feedback. So if once the model has been set, the template is finalized, it has been tried, tested, debugged, refined, well presented, then the model should be in a way put to use or deployed in a way, one can say. So historical data. So in financial statement forecasting, historical data plays a big role. So typically reasonable historical data should be considered. So use 3 to 5 years of financial data or financial statements for trend-based forecasting. So 3 to 5 years of financial statements in a way help to understand the trend in the various financial figures of the business, and therefore it ensures consistency because it sets the trend or pattern of a particular item, line item, and therefore it ensures consistency, not necessarily perfect accuracy, and includes industry and competitor data for benchmarking. So it should not be only standalone financial forecasting and financial previous historical data. It should also consider the industry data and competitor data for benchmarking the forecasting that is being done. Consider industry forecast, example industry parameters like GDP, interest rates, price trends, etc. Company plans, so it is very crucial for realistic forecast, and therefore the creator of the model should know what are the plans of the business of that particular organization. It should incorporate all the strategic plans, example new projects, expansions, while preparing the financial forecasting. And it should reflect the impact of various strategic plans on sales, cost, capital expenditure, working capital, and profits also. So one of the key financial statement forecasting is basis is the common size statement. So common size statement is nothing but vertical comparative statement. So vertical comparative statement, in that it is express the income statement, so each express income statement items as a percentage of total revenue and express balance sheet items as a percentage of total assets. This common size statement in a way helps in identifying significant changes or anomalies in various income statement items and balance sheet statement item also, because in a way it establishes the relationship with the revenue in case of income statement items and with the assets in case of balance sheet items. Thus, common size statements help in identifying significant changes or anomalies. So, in a way, comparative statement is also prepared. At the same time, vertical comparison is also done with the respective line items. So, both sides, in a way, holistic trend setting happens, and significant changes comparative wise or within the line wise also relationships are established, and if at all any anomalies or skewed figures are coming up, then the creator of the model can relook at the model that is being set. So this enables comparison between the firm of different sizes and for different period also. Then we saw the identifying the independent and dependent variables. So in forecasting approach, no single correct method is there. It depends all on business understanding and forecast quality. Sales driven forecasting is most commonly used. Sales as an independent variable. So sales growth rate often used as a key driver. Common size statements help identify which profit and loss items can be projected as a percentage of sales. Historical trends and stable relationships in common size statements guide initial forecasting. Use of industry data is very critical because it combines company specific data with the industry benchmarks and improved accuracy. Finally, it confirms assumptions using both historical and industry data. Another attribute of independent and dependent variable is the policy assumption. So include the management's target, debt to equity ratio, dividend growth in forecasting. So the creator of the model should be very well aware of the plans, strategic plans, that's one, and the various assumptions or management's targets that are being fixed by the management, and accordingly the modeling should be done. And now all these policy assumptions, interpretations, data, information, selective data, selective information, everything should be well documented for auditable purposes also and for measurement purposes also. Then there are certain non-sales driven items. Typically those are not while forecasting they can't be really linked to the sales figures, like interest expense, because interest expense in a way depends on the loan amounts that have been taken by the business. Depreciation is tied to fixed assets, methods, rates and asset useful life also. And taxes typically are based on profit before tax and statutory tax rates. So these three items, interest, depreciation and taxes, are non-sales driven items. Then we saw balancing the balance sheet. So even accurate forecast may lead to imbalances, and in such case use a plug to balance. Now typically the common plug, or the common plug means the residual figure. Normally the common plug items are the cash, marketable securities, and or short term, long term, debt and equity. So choice of plug depends on the financial scenario. Example, normal versus funding need. Ensure only one plug is used to maintain model clarity and integrity. Yeah, so with this, listeners, we come to an end of the today's session, of this session, which was all about financial modeling. So we'll stop for the session. See you, stay tuned. So this is signing off, CACS Pushkaraj Vishnu Joshi, and we have done with the chapter on financial modeling, which is 9.3. Sorry, pardon me, I haven't changed in this copy paste. Yeah, so we'll stop for this session and see you in the next session with the new chapter.